In this video, I want to explain our first of our 5 creative financing tools, and that is seller carryback financing. And I want to try to do it in a simple way and explain it based on maybe some transactions that you are familiar with, and that's by going through first showing you kind of a typical transaction and how the financing and how all the paperwork works in a typical transaction. And so you can see my fantastic artistic rendition of a smiley, happy-faced seller who is a happy owner of a house, and then they have found a buyer, and this buyer is also happy and they want to buy the house from the seller. So they decide to do a transaction, and the way this would typically happen, they have an escrow agent. In a lot of states that's an attorney, a title company. They handle all this, but what happens is that this person who owns the house, they actually give a title to the house, and that's called a deed. There are different types of deeds, but in most cases it's a warranty deed, and they give the deed to the buyer. That's the first part of the transaction. By doing that, they have transferred the ownership of the house to the buyer. So I think we all understand that. Where it gets a little bit, where things can get different is how the money works. So this seller, of course, is not giving the house away. They want to get some kind of compensation for giving them this deed. And by the way, this deed is a piece of paper, is a contract, and it's recorded at the local the municipality, wherever they record those in that county or that district. But it's a piece of paper that says, I transfer this, and they describe what it is to this buyer. Well, the money has to be transferred at the same time. And if it would be really simple if this buyer they agreed on a price with the seller and they just had the cash. They had the cash in the bank, and let's say it was a $50,000 purchase price, and the seller said, yes, I'll sell it for $50,000. The buyer says, I have $50,000, and they just go to the bank, they get a check from the bank, and they bring it at the closing, and they would just give all the money directly from the buyer to the seller by way of the closing agent. That would be a simple scenario, but we all know 99% of the time that's not what happens. In fact, the buyer might have some money. Let's just say in this case they have a 20% down payment, but the bank, and I'm drawing a bank here because it has to look like a temple in order to be a bank. It has to look like a Roman temple to make it look important and solid and like it can withstand a direct hit from a tank. But the bank has the money. And so what it does is it agrees, the buyer applies for a loan with the bank. The bank says, yes, that looks great. We like your job. We like your income. We like your credit. We will give you a loan. But we're not just going to give you the money by itself, an unsecured loan. We want to give the money to you at the closing table, but then in return for us giving you this money, and let's say it was a $50,000 purchase and the bank loaned $40,000. So it's a $50,000 total. The buyer put $10,000 down, you can read that, and the bank loaned $40,000. So $40,000 would be the amount of money they would send to closing, the bank would. And in return, the bank says, what we want is for you to give us 2 contracts. One is a promissory note, and this is the promise that you're going to pay back the bank, and has all the terms by which you agree to pay it back, including interest and when your payments start, and how long the loan. Is it 5 years? Is it 20 years? Is it 30 years? And there are all sorts of terms that go into this promissory note, and this is also called your debt. The debt instrument. The promissory note is the debt. You owe that money. But then in addition to that, that would be an unsecured note if that's all you gave the bank. It would be an unsecured debt, like a credit card. The credit card doesn't have any other collateral other than your promise to pay it back, your personal promise. But the second thing the bank requires is, because you're buying a house from this seller, that they want you to give them a mortgage, or in some states that's a deed of trust. Deed of trust. But in any case, whatever it is some kind of a security instrument, which basically is recorded against the house, and it's typically in first position, meaning there are no other mortgages or liens against the house. And this title attorney will do that search to make sure that the bank is going to be in first position, and will sell them an insurance policy that says they are in first position. And so this mortgage is recorded against the house, but the buyer, at the same time they're getting the money, they get the money, and then they give the bank this at closing, a promissory note and a mortgage to secure the property. And after they have fulfilled all the terms the buyer has of this promissory note, the bank agrees to cancel that mortgage, or to satisfy that mortgage. In addition to that, you usually have to give your second child if you're getting a loan as well. But Just kidding. That's why we're doing creative financing, so we don't have to give up our second child, right? They don't have any daycare at the bank temple anyway, so I don't think they'd accept most of our second children. That would be a problem. But I digress a little bit. The mortgage, the promissory note, that's the paperwork that goes back and forth. And at the end of the sale, the seller gets all of the money. So the seller gets $10,000 from the buyer and gets $40,000 from the bank. But in total, the seller gets $50,000. So the seller gets all of their money. So if they asked $50,000, they got $50,000. And that is your typical transaction. The seller might pay off a mortgage himself or herself, but that's your typical transaction. Now I want to contrast that. You probably understand that, or maybe that's a little bit more detailed than you've seen before, but you understand that type of transaction. Maybe you've done it yourself. But I want to explain to you what seller carryback financing is. It's the same scenario except for there's no bank involved. The bank has been taken out of the equation. So what happens is you have a seller, the seller owns a house, you have a buyer, the buyer wants to buy the house, and they agree ahead of time on a price. And so the seller says, I would be happy with $50,000. The buyer says, I'd be happy with $50,000. But I would like to do that I don't have $50,000 sitting around. I do have $10,000, just like they did in the other scenario. And so I can give that to you as a down payment. $10,000. And so the seller is going to get that $10,000 directly from the buyer. And so far it is exactly the same as the other scenario. The only difference is that the promissory note and the mortgage are not going to go to the bank. The seller is basically going to wait on the other $40,000 and to secure the fact that his equity or her equity is sitting out there waiting. He's going to say, it's very similar to a loan. He's going to say, I'm not going to wait on my $40,000 and just without any other promises from you. So I want a promissory note and I want a mortgage, just like a bank would. And so and this is also called an installment sale, in case you've heard that term before, installment sale. And the reason it's called that is because you're paying for the house in installments. And just to make this sink in, this is actually different than a loan. A loan, remember, you actually had money being transferred. The bank actually had a check for $40,000 that they gave to this borrower. In this case, is the seller actually loaning the buyer $40,000? They're not. There has been no money given from the seller to the buyer. This is actually it's the terms of a sale. That's why it's called an installment sale, and it's a fundamental difference between the two. And in many cases, people will say you're loaning money. The seller's loaning money to the buyer, but that's not the case. It's an installment sale, and so you're paying back that $40,000 typically with interest, and so that you're paying it back. And all those terms are outlined in the promissory note, and then the mortgage or security is just the security for the seller in case you don't do what you promised. They can then go foreclose on you, and they can take the property back. And so this mortgage is the document that connects the debt, the promissory note, to the property, because the buyer has the deed in this case. So this is the scenario. Seller is basically the bank. You can think about it that way, but they're not really giving a loan. Like I mentioned, there is an installment sale. But very much the transaction looks like the bank loan, just minus that third party who's being involved. Another term you might have heard, I wanted to explain this too, is that it's called a contract for deed or a bond for title or a land contract. And just to quickly explain what that is, it's the very similar scenario. It's also a seller carryback transaction or installment sale. People do that. The only difference is that in a seller carryback with a contract for deed, a bond for title, or a land contract, the deed is not actually transferred at the time of the closing. So the seller will actually hold on to the deed. The seller is going to hold on to the deed, and instead they still have the buyer still gives a down payment, and what the seller says is, I'll give you a contract. So they sign a contract between. It's very similar to the concept of a purchase and sale agreement. But I said, we're going to sign a contract together, and then you're going to record that contract at the courthouse, And most of the local municipalities will they recognize a contract for deed or a land contract as a form of purchasing the house, and they'll let the owner get the lower tax rates as an owner. And so it is a traditional way of buying a house. But as security, the seller is saying, I'm going to keep the legal title to the house. You're going to pay me down payment, and then we're just going to have one contract. We're not going to have the promissory note and the mortgage. We're just going to have one contract that lays out all the terms of the interest rate, the length of the loan, the amount of payment, and then after that, it says when you have fulfilled all the terms of this contract for deed, then I, the seller, will give you the full deed to the property. So very similar, and we could go into all sorts of nuances on why somebody would or wouldn't do that as a buyer and a seller. I have done both as a buyer and a seller, contract for deed and the regular seller carryback, and had reasons to do those in those cases. But at this point, I want you to understand the concept. I hope that makes it a little bit clearer what a seller carryback transaction is. We're going to go into case studies and show you investment examples where you are the buyer as an investor and go to a seller who can finance the house to you, and you can make it a profitable deal for you, and also a win-win, a profitable deal for the seller as well. And so we'll show you how that happens and how you can do those kind of deals, and that's really a big part of what this course is all about. So I hope that was helpful, and I'll see you in the next video as we go over another of the types of creative financing.